I definitely agree with this to a certain extent. You definitely want to follow the Fed and the money, but you don't want to follow it too closely because then you could easily get lost in it, especially with all the movements that go on. By understanding different market cycles, this is what you'll learn. Around when a recession is coming, around when the market bottom is going to be hit, when the market is going to continue to grow, and if it's a good time to invest or not. Imagine you invested in 2006, specifically in August, and you didn't know there was going to be a recession in 2007, but you ended up investing right around the time that the 10-year Treasury and 3-month T-bill spread became negative for the first time since the past recession. You invested in a company that followed very similarly to the S&P 500. Let's say the beta was about 1. This is one of the only times I talk about beta. So the stock was performing really well, and you were really excited, but then all of a sudden, starting in 2007, something drastic started to happen, and the stock started falling drastically. You weren't fully sure. You thought maybe it had something to do with what was going on with the Fed and the economy, but you didn't know that we were about to hit a recession. And then in 2008 and 2009, when we're still in the recession, you end up selling the stock because you're just scared, and it's really dropped a lot. Imagine instead of this, if you knew market cycles and you just invested more money that you had when the stock fell drastically. Or maybe you decided to invest before a recession into defensive stocks to protect yourself, and you actually could have made a return because there are stocks that do perform well when the market is down or we're heading into a recession. Knowing market timing is so important. Combine that with knowing about the Fed and the movement of money or the flow of the currency in the United States. This is the answer.